Welcome to ValueVest Daily. This video is strictly for educational purposes and does not constitute financial or tax advice. The stock market is reaching record highs. At the same time, major tech firms are announcing significant workforce reductions. These events signal a coordinated shift in capital, moving from human payrolls and into the physical infrastructure of compute. Before we continue, we've seen your request for a breakdown on IMS, so look for a dedicated report on that next week. Investors who fail to recognize this wealth transfer risk being sidelined by automation, while those who pivot towards semiconductor moats are positioning themselves to capture the upside. Meta recently eliminated 16,000 roles, 20% of its total workforce, to reallocate that capital away from its metaverse projects and into AI efficiencies. Amazon is executing a similar strategy, cutting 16,000 corporate positions to fund an automation push that targets 75% of its operations, potentially displacing 500,000 workers. Gartner projects that many of these firms will begin rehiring by 2027, but current data from Forrester shows that over half of these companies already believe they cut staff too quickly. Even if rehiring eventually occurs, the immediate result is a 10 to 20% increase in entry-level unemployment, necessitating an aggressive build-out of AI infrastructure to maintain existing business operations. Corporations are liquidating their human resources budgets to finance the purchase of silicon, hardware, and photonics. This chart tracks the global semiconductor market reaching a total addressable market, the maximum revenue opportunity, of $1 trillion by 2026. Within that, AI data centers account for $600 to $630 billion in annual expenditure. NVIDIA remains the central player in this spending surge due to its command of the GPU market. AI workloads are split between training, where models learn from data, and inference, where they generate outputs. NVIDIA's hardware is a requirement for both processes. This line graph shows NVIDIA's revenue trajectory towards $213 billion, a 73% year-over-year increase, relative to its current share price of approximately $190. Analysts have set price targets between $250 and $352, suggesting an upside potential of 30 to 85. This pie chart details Broadcom's position, illustrating their projected $55 to $60 billion in revenue generated solely from AI-related hardware. They further protect their market share through photonics, which uses light to transmit data between server nodes faster than traditional electronic components. Broadcom provides the efficiency required to lower the operating costs of these massive AI clusters. AI systems face a physical bottleneck. The processors simply cannot analyze data faster than the underlying memory hardware can provide it. Micron Technology is filling this gap, showing 50% overall growth and a 60% compound annual growth rate within its AI division. This chart compares price-to-earnings ratios, showing Micron is currently valued at 28 times earnings, which is lower than many of its semiconductor competitors. Market analysts maintain a consensus price target of $305, which would reflect a steady increase from current trading levels. High bandwidth memory from Micron is a strict physical requirement for these data centers to operate at their design speeds. TSMC is the physical location where the hardware for the global AI stack is manufactured. They operate as a foundry, holding a near monopoly by manufacturing 90% of all advanced chips globally. A foundry specializes in fabricating semiconductor designs. This is a capital-intensive moat. The physical requirements for chip fabrication are nearly impossible for software companies to replicate. Building a single factory capable of producing advanced chips now costs approximately $30 billion. This financial matrix shows TSMC's growth from a current price near $375 toward an analyst target of $500 or more, driven by a 60% AI growth rate. This fabrication bottleneck suggests a 33% upside potential if these targets are met. Because no other entity can fabricate these chips at scale, companies like NVIDIA and Broadcom are entirely dependent on TSMC's manufacturing capacity. Institutional investors and analysts are currently prioritizing these hardware moats to protect capital from broader economic shifts. The primary risk to this sector is geopolitical, specifically the concentration of manufacturing facilities within Taiwan. There is also the possibility of internal competition, as custom chips from Broadcom could reduce the long-term demand for NVIDIA's general-purpose hardware. Maintaining a diversified position across all four of these companies provides a hedge against the specific technical or political risks facing any single firm. Diversification allows an investor to capture the broader flow of capital into AI without betting on a single hardware architecture. Investing in these hardware enablers allows you to recapture the value currently being moved out of the human labor market. As the data center market expands toward $1.2 trillion by 2030, these foundational companies are positioned for continued long-term compounding. Rather than attempting to time the market with a single purchase, a more stable approach is dollar cost averaging. Dollar cost averaging is the practice of investing fixed amounts at regular intervals to reduce the impact of price volatility. This allocation matrix divides a strategy into 4 areas: NVIDIA for compute, Broadcom for custom chips, Micron for memory, and TSMC for manufacturing. By making consistent monthly contributions, you smooth out price fluctuations while building a meaningful position in the infrastructure powering the AI economy. As AI adoption continues, capital flows toward the organizations that build and control the physical infrastructure. Please subscribe, like, and share ValueVest Daily for daily learning opportunities before putting your money to work. Please put in a comment below if you want us to do a deep dive into any specific high-risk, high-reward opportunities. With labor displacement accelerating, capturing value through foundational silicon hardware offers a mathematical hedge for your financial future.